Grow an actively managed portfolio of gold, silver, platinum, palladium, and rhodium with Octus Metals today.
This is going to be a disaster. 2026 is going to be a horrible year for U.S. financial assets. Stocks, bonds, cryptocurrencies, I think they all get killed.
Hello again, everyone, and welcome to another edition of the Octus Edge, where we look to give investors the edge they are looking for. I'm your host, Patrick Vieira, Chief Economist and Global Strategist for Europac.com, Chairman of ShiftGold.com, and founder of ShiftSovereign.com, and host of ShiftRadio.com. Peter Schiff joins us today. Peter, welcome to the Octus Edge. How are you doing?
I'm doing good. How are you?
I'm doing great. Glad that you're here. Geez, quite a lot to talk about. We'll try and get through this. But, Peter, the obvious, you are in the precious metal space. When you wake up each morning and see the nonstop volatility, what goes on through your mind?
Well, I'm not seeing volatility so much as just up and to the right. I mean, gold and silver just go up every day. There's some swings, but we're at all-time record highs. Gold is over 4,700 right now, 4,750, and silver was over 95 this morning. It's pulled back, now it's back below 94, but it just keeps making new record highs. Meanwhile, we're finally starting to see some solid strength in the mining stocks. Even though silver is backing off its highs, a lot of these stocks are now making new highs, which they should do because they're still ridiculously cheap. So there's just tremendous opportunity. I had, coming into 2024, I had about half of my portfolio in precious metals mining stocks. Now it's probably more like 70, 80% because those stocks have tripled and the rest of my portfolio hasn't gone up that much. It's gone up. All of my non-gold stocks have also done well, but not nearly as well as my gold and silver stocks. But, as big as 2025 was, 2026 is getting off to a much stronger start by far. I mean, we didn't even start moving last year until Q2. So as good as last year was, this year could be better, if you're invested in those stocks. I mean, for most Americans, I think this is going to be a disaster. 2026 is going to be a horrible year for U.S. financial assets, stocks, bonds, cryptocurrencies. I think they all get killed.
Yeah, in fact, that was something that I saw you recently tweeted out where you had stated by the end of the year, holders of U.S. dollar-denominated assets and cryptocurrencies, including Bitcoin, will be substantially poorer than they are today. In contrast, holders of... Okay, go ahead.
Yes, exactly. I mean, we had a good thing going, although it was unsustainable, but we had a ride on the global gravy train. And, that enabled Americans to live beyond our means. We had higher asset prices and lower consumer prices. We didn't have to save, yet we still had low interest rates. And all that's coming to an end. I mean, Donald has finally given the world a reason to do what it should have done decades ago. And that's jettison this whole U.S. dollar-based monetary system where we issue the world's reserve currency. And I think maybe the nail in the dollar's coffin ended up being Greenland. Who would have thunk it?
Yeah, man, that's a different topic altogether there. But let me ask you, Peter, with silver recently breaking out to new all-time highs above that $95 level, as you mentioned, and gold pushing past 4,700, are we in parabolic territory, or are we in that territory even yet?
For the metals?
Yes.
Well, I think that we're going to be moving up at a very sharp angle, whether it's parabolic or not. But I think there's, now a rush to get out of dollars and therefore into precious metals. And so you have a lot more people now that are waking up to what people like me were aware of for years. And so it's kind of been a slow migration for a small percentage of the population out of dollars into gold and silver. And as that was happening, the price gradually moved up from under 300 to 3,000, from 2001 to 2024. But the trajectory started to pick up in 2024 as the central banks got in on the action. And now in 2026, this is where I think the mainstream investors and the institutions are going to start participating. And so we're just going to have a lot more investor demand for precious metals, but not a lot of supply of precious metals to meet that demand. And of course, there's growing industrial demand too, especially for silver right now. So, it's the perfect storm of exploding demand and, relatively stagnant supply. And in fact, as far as for industrial use, the supply is going to be going way down because investors are scooping up all the inventory. So if you actually need silver, you're going to have to pay up to get it.
Yeah, and geez, a lot of us are. The prices at the shops now, they're up, man, they're up there. But Peter, silver percentage wise is outgaining, even outpacing gold. And this year already, gold is up some, I think, about 8% or so year to date, and silver is up about 30% or so year to date. Do you see sort of a rotation happening where gold investors may rotate into silver or even perhaps platinum?
Well, I think what silver and platinum have done is just catch up to gold, because gold really went from 2,000 to 4,000 with very little movement in those metals. And now all of a sudden the markets are catching up to where they should have been all along. So I don't think that you're going to see a big reduction in the demand for gold. I think that's going to continue. I think that what you had prior to the last few months was the demand was concentrated in central banks. And so central banks just didn't buy silver. They just bought gold. But now that you have private investors getting in on precious metals, they buy both. And in fact, in many cases, they lean more towards silver than towards gold. So I expect the demand for both metals to continue. And I would imagine that over the next several years, silver will continue to make progress relative to gold, because I think historically it's still underpriced. It's not as ridiculously cheap. We were over 100 to 1, earlier last year. And so you're never going to see, although never say never. I mean, probably not in my lifetime, but maybe in somebody's lifetime. Maybe that'll happen again. But I don't think I'll ever see a situation where I can buy 100 ounces of silver for an ounce of gold. I think that's done. And in fact, you think silver prices are high at $94. Pretty soon, you're going to look back at silver in a double digit at a cheap price, because silver is still under $100 an ounce. It's not going to be under 100 for long, and then once it really gets above 100, it's never going to go below it. It's just going to keep on rising.
Yeah, that's a great point. I remember, guys saying just silver at under $20 is a good buy. Silver at under $30 is a good buy. And here we are almost at 100. But you said something pretty interesting where, the central banks have been buying up gold and that, elevated the gold price. Is it now perhaps the institutional investor who is seeing the how silver and platinum are both undervalued that may be pushing up the silver and platinum price now?
Yeah, well, there is investor demand finally coming in. And that is being fueled now by the exodus from U.S. dollars. The world is getting out of the dollar. And, that now it's a matter of economic and military survival. I mean, Donald just told the world, as long as we have the number one economy and the number one military, we could do whatever we want. There's no limit to what we can do. If we want to invade a country, who's going to stop us? And so the way to stop us is to, destroy our economy, destroy the value of our currency. And that's what's about to happen. The U.S. is going to lose this war without any shots being fired. We're doomed economically because we've been dependent on the world, and we just bit the hand that feeds us. And now they're going to stop feeding us.
Last year, we saw phenomenal gains in precious metals and in particular with silver and platinum, gaining roughly twice as much percentage-wise comparatively to gold. This may be the year you would want to rebalance your metals portfolio and get in on these gains. To do so, contact us at www.octusmetals.com and we'll tell you how you can do just that. Yeah, we're gonna touch on this very shortly, but I had a guy on X. He wanted to ask you a question. His name is Stephen Young. He noted that the Japanese bond market looks to be, let's say, unraveling a bit. What would be the effect on physical gold, silver, and mining stocks should we see trouble with the Japanese bonds?
Well, the Japanese bond market, yields rising, and now they're about almost 2.4% on the 10-year. They were this time last year, they were probably still under 50 basis points. It's going to put a lot of upward pressure on treasury yields. And it's also going to put downward pressure on other risk assets in the U.S. that benefited from the Japanese carry trade. Because a lot of that margin debt is going to be repaid, especially if the yen starts to rise. I mean, so far, the backup in yields has not pushed the yen up. But if you start to see the yen rising against the dollar, that's going to force a lot of repatriation into Japan.
Okay, you've said gold, silver, the rally that we're seeing is a harbinger of a brewing financial storm. What warning signs are you looking at in the U.S. dollar? Is it the treasuries, the bond yields? What are you watching the closest right now?
Well, I mean, I know treasury yields are already backing up. They're at the highest they've been, since August last year. But they're going a lot higher. But you're going to see a break in the bond market and a break in the dollar. Gold and silver moved first, so they were the real advanced warning that there's a problem in the financial system, and you saw it first in precious metals. Now you're going to see it in the dollar and in the treasury market, and then eventually the stock market, is going to roll over too. Maybe it's already started here today. We'll see. Stock market may be the last shoe to drop. Stocks, real estate, but we're in for a world of trouble here in 2026.
Yeah, I'll agree with that. Do you think the Fed will be renewing quantitative easing or maybe even aggressive rate cuts in 2026? And will it be due to political pressure or weakening economic data or perhaps rising yields? And again, how would this impact maybe gold, silver, inflation, or generally the economy, I guess, let's just say?
Yeah, well, we've already got QE. I mean, remember, we already have it. The Fed they're just not calling it QE, but they're printing money. They're expanding their balance sheet. They're buying treasuries. So it's already started. It's going to be expanded. They'll be doing a lot more QE later in the year than they're doing now. The question is, when are they going to fess up and admit that that's what they're doing? But also, Donald has got the GSEs doing their own version of QE. They're buying $200 billion worth of mortgage-backed securities. All right, so the government is already artificially trying to manipulate interest rates lower. And as market forces try to push interest rates higher, you're going to see the government and the Fed doing more to try to artificially suppress them because we're all too broke. That's the reality, is that we can't afford the higher interest rates. And so we're going to use the government to try to prevent rates from rising. But that's what's going to fuel the inflation fire that's going to burn down the dollar.
Okay. And Peter, how do we implement this sovereign wealth fund with all these things that we're talking about?
What sovereign wealth fund? For the United States?
Yes.
We don't have any sovereign wealth. We just have sovereign debt. I don't know. We have to pay off our debt before we started accumulating any assets. We're 38.6 trillion in the hole right now.
Yeah, good point. Because I know that idea of a sovereign wealth fund has been floated around with the administration. So I'm just kind of wondering.
Yeah, well, the Trump administration is full of economic ignoramuses. I mean, it's the blind leading the blind over there.
All right. And you've also said the U.S. cannot afford to service its debt, let alone repay it. I mean, with that, are we going to see maybe capital controls, higher taxes? Is it ever going to be paid off, or how will they even try to do it?
No. Paying off the debt is impossible. Though inflating it away is something they could do. But of course, when they inflate it away, they destroy the value of everybody's savings. You know, everybody gets wiped out if you have dollars. So it's not like it's a get out of jail free card. You know, you destroy the currency, you have hyperinflation. That's not going to be good. Yeah, we'll be out of debt, but we'll be in a whole new problem that's going to be worse.
All right, and you know, you've often compared the current setup we are in with the pre-2008 warnings. Do you think the eventual crisis could be worse in 2008, given higher debt levels and more leveraged financial systems?
Oh, I mean, it'll definitely be worse for America. It won't. It will actually be a positive for the rest of the world. You know, but it's so it's not going to be a global financial crisis. This is going to be a U.S. financial crisis. Yeah, I mean, so the rest of the world's going to actually, be relieved of a burden, and it's the U.S. that's in for a world of hurt.
Okay. It's interesting because I think, you know, a lot of people say globalization is dead. We're heading into some sort of regionalization. And within that, we're seeing, you know, nations really looking to grab resources within their regions. Um, how do you think this is eventually going to play out? Because we're seeing friction already between, you know, what once were allies.
Resources are going to be very valuable. I mean, obviously, that's why we went down to Venezuela, because they got a bunch of oil. Apparently, we want Greenland because they have oil and gas and they have strategic minerals. But, you know, it's so expensive to extract them. That's why, you know, they're not being extracted now. And I mean, people aren't exploiting the resources in Greenland because it's not worth it. It's like, you know, it's very harsh Arctic conditions. And so whatever they got, it's very difficult to get it, very expensive. So, you know, if we end up buying Greenland, we'll probably be overpaying for it. Meanwhile, we're broke, so we'll have to borrow the money or create a lot of inflation to get an island that we can't really do much with.
All right. And
I mean, maybe it has a strategic military importance, but we don't have to buy Greenland or invade it. I mean, I'm sure the Greenlandiers, whoever you call them, would be happy to lease us some of that, you know, that Arctic tundra, so that we can have a base. They'd have no problem with that.
all right, so they'll give us the best of the Arctic out there, right? So we can have the most real estate gains. All right, and yeah, you did mention that point about Venezuela and the oil, but I mean, overall, this resource war, and again, silver is caught up in it, platinum is caught up in it. But do you see some type of government maybe taxation on it, or taking away some of the gains that people may get on it?
Yeah, I mean, that's one of the reasons I moved to Puerto Rico, is because I'm exempt from the capital gains tax. But I would not be surprised. I mean, the amount of money that I'm going to make, I think, and that people that are following my advice or just doing what I'm doing based on their own, judgment, we're going to make a tremendous amount of money. And it's possible that they could try to target us with a windfall profit tax by trying to vilify us and blaming the gold speculators for the collapse of the dollar, you know, and we should have to pay a huge tax. You know, why should we profit when everybody else suffers? I can see that kind of, you know, demagoguery and scapegoating of the people who don't go broke, because most people will go broke and they will be looking to point the finger at somebody. And the politicians never accept responsibility. They're always looking to blame somebody. So they might as well blame the people who got rich and say, you see, you did something, you know, like I have any power to do anything, you know. all I could do is see the truth, and I could react to it, but I have no ability to influence anything.
Yeah, truth is so important nowadays. Peter, if you had to choose one, which do you think would happen? Confiscation of gold or heavy taxation of gold, where turn it in by a certain date or get heavily taxed afterwards?
Well, you know, I don't know. It's hard to confiscate gold. I mean, you have to rely on people to turn it in, and I don't think most people will turn it in if the government tells them to. It's very hard for the government to find it. You know, it's much easier to just to seize your your stock portfolio or something like that, or your real estate. They can see it. They can grab it. But I think as long as they have the printing press, that's going to be the primary tool that they use to confiscate wealth. They're just going to keep printing money. Now, if the money becomes worthless, right, we have hyperinflation, then of course printing money doesn't do any good. That's when they would start, nationalizing and seizing stuff. But the hardest thing to seize is going to be gold because it's the hardest to find. You don't know that anybody has it.
Yeah. You still see stagflation or recession or hyperinflation? I mean, I know you just mentioned hyperinflation, but stagflation still in the works?
Well, we have stagflation. I mean, we've had that, for years, but it's just going to get worse. It's not just stagnation, it's outright recession, depression, and it's going to be high inflation. Whether we end up with hyperinflation, the way you would classically define it, I don't know. I mean, maybe we avoid that. That would be the worst case scenario, but it's certainly, you know, on the table now as a possibility. It's not like you can rule out hyperinflation. You can't. It is a real possibility of the way this situation is going to end up.
Right. Outlook for 2026, still early in the year.
More of the same. Gold and silver higher, gold stocks higher, dollar lower, yields higher, foreign stocks outperforming domestic stocks. You know, it's still, obviously not too late for your viewers to get themselves properly positioned. If they didn't do it last year, hurry up and do it this year. You got my mutual funds. You can learn about them at my website at europac.com. 5 funds available everywhere, no load. You can also work with my advisors at Europe Pacific Asset Management. We have separately managed accounts. We have wrap accounts. Just talk to us about how we can help protect your wealth. And make sure you buy the physical gold and silver from me at Shift Gold. And in fact, I have a new program, T Gold. You go to tgold.com. I'm going to be developing a gold-based payment system and a platform for commerce, including tokenization. That's where I actually got the T Gold, because you'll ultimately also be able to withdraw your gold in the form of a token. So you can have physical gold or you can have a token, depending on how you might want to use it.
Okay, it's good insight. Any other way people can follow you? I mean, your X account or any place else?
Yeah, well, the X account is where I'm most prolific. I've got about 1.3 million followers there now, and I constantly put my thoughts on X and put them out there. But people should also make a habit of listening to my podcast, shiftradio.com, on my YouTube channel at Shift Gold. And, just I'm on social media. So just follow me, subscribe to my YouTube channels, then follow me on X and TikTok, Instagram, Facebook. I mean, wherever, I'm on all these platforms. But also just make sure you tell your friends. We got to spread the word. There's so much misinformation out there. I'm one of the few people that's spreading the truth. I'm not the only one, but we're a small minority.
Yeah, I can see that all over the place on X and wherever else that the truth is getting harder to find nowadays. And if you're brave enough to speak it, well, you better be brave enough to speak it. But Peter Schiff, I want to thank you for your time. I know your day is just starting and you probably got a bunch of things to do. So I hope we can do this again soon.
All right.
And let's stay in touch.
Take care.
That was Peter Schiff from Shift Gold, sharing his insights on the markets and metals. And this may be the year for you to reallocate your metals holdings. If you'd like to know how you can do just that, do contact us at www.octusmetals.com.
Grow an actively managed portfolio.
Gold. It's been valuable for, well, basically forever. But can you actually use it in today's tap-and-go world? It seems impossible, right? Well, today we're going to dive into a system that's designed to do exactly that. To take one of humanity's oldest assets and make it spendable in our modern digital economy. It's a pretty wild mix of ancient value and very new tech. So why would anyone even bother trying to do this? It really starts with this quote from G. Edward Griffin, and it's a killer analogy for inflation. He says that while we're all distracted by the big show, inflation is like someone quietly out in the parking lot stealing our hubcaps, one by one. You don't even notice it's happening until it's too late. That's what's happening to the value of our money, just being silently stripped away. And that really raises a huge question, doesn't it? What if you could just opt out of that game? What if you could actually transact with something that has real, tangible value, but do it with all the speed and convenience we expect from modern finance? All right, so here's our game plan for this explainer. First, we'll look at the big problem with gold itself. Then we'll explore this parallel ecosystem they've built to solve it. After that, we'll see how they actually make gold spendable, how they connect it to the regular cash economy, and finally, we'll check out the legal armor that holds this whole thing together. Okay, first up, the gold conundrum. Look, for thousands of years, gold has been the ultimate way to store your wealth. No question. But here's the problem. You can't exactly walk into a coffee shop and buy a latte with a gold coin. It's incredibly valuable, but it's just not practical for everyday life. So, to build a new system, you have to start with the most fundamental question. Who really owns your money? In a traditional bank, when you deposit your cash, you become a creditor. The bank owes you an IOU. But this system uses a completely different structure, a trust. The key difference here is that a trust is more like your own personal safe deposit box that they just manage for you. You always retain the legal title. You are the owner, period, not just someone the bank owes money to. And that ownership model is really the bedrock of what its creators call a sovereign parallel ecosystem. Now, the word parallel is key here. The idea isn't to replace the current system, not at all. It's about building a voluntary framework that operates right alongside it, giving people a choice to transact with what the founders call money with indestructible value. And look, this isn't just some idea cooked up in a garage. It's actually built on a real legal foundation of state sovereignty. It leverages laws like the Utah Legal Tender Act, which recognizes gold and silver as legal tender. And it's not just Utah. Over 40 states have taken steps like this, creating what the system's architects call a bulwark against federal overreach. So you've got this legally recognized sound money that you own directly. That's great. But we're still stuck with that coffee problem, right? How do you actually make it practical to spend? Well, the answer is a fascinating concept, tokenization. The first way they do it is through what's called physical tokenization. It's a fancy term for a really simple idea. You take a physical asset, like pure gold, and you transform it into small, standardized, and easily spendable units. And the prime example of this is the Goldback. Now, this is really important. This is not a paper certificate that represents gold sitting in a vault somewhere. No, the gold is physically inside the note, deposited atom by atom. Each one is serialized, it's verifiable, and it's basically like a very thin, flexible coin that contains its own value right there within it. So that's the physical method. But what if you need to make a transaction at a distance? That's where digital tokenization comes into play. In this case, they use blockchain technology to create and transfer smart affidavits of ownership for gold that's held securely in a vault. The value moves instantly without ever having to ship an ounce of heavy metal. Okay, so how do you trust a system like this? It's all built on what they call a trust triangle, which is designed to separate powers. You've got Alpine Gold handling the day-to-day operations, then there's Notary Chain, which deals with the independent auditing and legal compliance, and finally, the physical gold itself is held by a trusted custodian, like Brinks. The key is that no single party controls both the assets and the records, which is a powerful safeguard against fraud. So now we've got spendable gold, both in physical and digital form. But how does that connect to the mainstream economy, where, let's face it, most merchants still want dollars? This is the bridge to creating real-world liquidity. And the main tool for this is a linked Visa card. When you swipe it, the system does something pretty slick behind the scenes. It performs an instant, just-in-time conversion. It sells the exact amount of your vaulted gold needed for that specific purchase and then pays the merchant in dollars. So you're effectively spending the value of your gold anywhere Visa is accepted, all while minimizing your exposure to fiat currency. This whole setup enables a strategy they call the 10% rule. The idea is pretty straightforward. You keep the vast majority of your wealth, say 90%, safely stored in gold, protected from inflation. Then you only keep a small liquid buffer of about 10% in cash on the card for your daily expenses. It's a way to stay liquid without being constantly exposed. Now, for bigger cash needs, there's another tool, the Gold Equity Line of Credit, or Goldie Luck. This lets you borrow cash against your vaulted metals. It's almost like pawning your gold instead of selling it, which is huge because it allows you to get liquidity without creating a taxable event. And finally, let's look at the legal armor. I mean, a system like this has to navigate a really complex regulatory landscape, and it does that with some very specific and pretty clever legal strategies. One of the key legal pillars here is how the system uses the Uniform Commercial Code. A convertibility clause allows an asset, like a Goldback, to be legally defined as an instrument. You can think of it like a coupon or a bearer bond, rather than a commodity. The whole point here is to allow it to circulate like a currency and potentially minimize exposure to capital gains or barter taxes. And we come right back to this trust triangle, because it is absolutely fundamental to the legal armor. That revocable trust structure means your assets are legally separate from the institution itself. So if the exchange were to fail, your holdings are protected in a way they would never be in a traditional bank, where you're just another creditor standing in line. So to wrap it all up, the entire ecosystem really rests on these 4 pillars. First, you have true ownership through that trust model. Second, you have spendability, thanks to physical and digital tokenization. Third, you get real-world liquidity with the linked debit card. And fourth, it's all wrapped in that robust legal protection built on the UCC and state laws. You know, it's a really comprehensive attempt to solve an ancient problem. By combining these age-old principles of sound money with modern commercial and legal tools, it presents a totally unique model. And it really leaves us with a fascinating question to think about. Is this a blueprint for a voluntary, grassroots financial future?
Picture this. You're at a baseball. It says, all right, picture this. You're at a baseball game.
Okay.
It's bottom of the ninth, the bases are loaded, and the crowd is just, it's electric. You are completely locked in.
I can see it. Total focus.
Total focus. You're watching the pitcher, you're watching the batter, you're yelling at the ump, you're not thinking about anything else.
The classic distraction. The circus part of bread and circuses.
Exactly, because while you are glued to that field, G. Edward Griffin, the author of The Creature from Jekyll Island, he says something else is happening.
Something outside the stadium.
Way outside, out in the parking lot. While everyone's inside, distracted, someone is just methodically walking row by row and stealing the hubcaps off your car.
That is such a visceral analogy. It really sticks with you.
It does. And in this analogy, the baseball game, that's the economy you see on the news.
The stock market tickers, interest rates, the latest bailout drama.
All of it. We watch the plays, we cheer for our team. But the hubcaps, that is your purchasing power. And Griffin's whole argument in the source material we're looking at today is that the game is designed to keep you looking at the scoreboard while inflation just quietly strips your wealth away.
It's the hidden tax.
Yeah.
The one you never vote on, but you pay every single day.
So for this deep dive, we're doing something a little different. We're going to ignore the game. We're walking out to the parking lot.
Okay.
We're looking at a stack of documents about the Alpine Gold Exchange, the United Precious Metals Association, and this whole concept of sound money. And we're trying to answer a huge question.
Which is
it actually possible right now in our modern digital world to completely opt out of the Federal Reserve System?
And not just, burying gold in your backyard. We're asking if you can actually live on a gold standard.
Yeah.
Like buy groceries, pay your mortgage.
Run a whole business without ever touching a fluctuating dollar. We've got legal briefs, tech specs on gold nanotechnology, and transcripts of a pretty intense conversation between Griffin himself and the executives at Alpine Gold.
So where do we start?
Let's start with the problem. I mean, why go through all this trouble to build a parallel economy? Why not just, keep your money in the bank like a normal person?
Well, according to these documents, that phrase itself, keeping money in the bank, is sort of a linguistic trap. We think we know what it means.
But legally,
It's something else entirely.
this is where Griffin and Mark Hilton, who's the president of Alpine Gold Exchange, they really get into the weeds on fractional reserve banking.
Right.
I think most people have a vague idea of it. The bank lends out your money, right? But the legal reality is way harsher than what you learn in Econ 101.
For sure. The common idea is, okay, I deposit $100, the bank keeps 10 and lends out 90.
Seems like a business model. A bit sketchy, maybe, creating money from nothing, but a business model?
But the key detail, the one Griffin hammers on, is the change in legal title.
Okay, what does that mean?
When you deposit that $100 into a regular bank, you are no longer the legal owner of that money.
Wait, what?
You lose title to it. You become an unsecured creditor to the bank.
Unsecured creditor. That's the phrase that just jumped out at me from the transcript.
It means you've given the bank a loan. You don't have money in the bank owes you money,
So if the bank fails,
which is a constant risk in a system where they've loaned out 90% or more of their deposits. You don't have a right to get your specific dollars back. You just have a claim.
you're just another person standing in line.
Standing in line, hoping there's something left after the big secured bondholders get paid out. You're at the back of the bus.
That is genuinely terrifying when you put it like that. You think you're using a safe deposit box, but you're actually an investor in a highly leveraged fund.
That's a great way to put it. And Griffin makes this really interesting libertarian point in the discussion. He says he doesn't think fractional reserve banking should be illegal.
Right. I saw that. He wasn't calling for a ban.
No. His view is if you want to put your money in a high-risk bank for a shot at high interest, you should be free to do that. Take the risk.
His problem is the compulsion.
That's it. We are effectively forced into this system. Legal pender laws and just the lack of any other real infrastructure make it almost impossible to use anything else. We don't have a choice.
Until now. Or at least that's the promise we're exploring. But before we get to the solution, we have to talk about the end game.
Right.
Because if inflation stealing your hubcaps is the slow burn, what Griffin and his colleagues see coming next is, well, it's the repo man coming for the whole car. We need to talk about CBDCs.
Central bank digital currencies. Yeah, this is the heavy stuff.
In the interview, Griffin's argument is that the banking establishment, they aren't even trying to save the current system.
No, they know the math is broken. The debt's too high. It can never be paid back in, real terms.
They know the system is dying.
Griffin says they are fighting to destroy it. The goal isn't to save the dollar, it's to replace it.
With the digital dollar. But,
Digital dollar.
I mean, isn't most money already digital? I haven't seen a physical paycheck in years.
It's all just numbers on a screen. That's true. But what makes a CBDC totally different is one word: programmability.
Programmability. What does that mean in this context?
It means the issuer, the central bank, can build rules directly into the money itself. With cash, or even our current system, I can buy a steak or book the government doesn't like, and nobody can stop that transaction.
It's neutral.
It's permissionless. A CBDC is the exact opposite. It's permission-based money.
So give me an example.
The ones they discuss are chilling. Imagine trying to buy a plane ticket and your payment is declined, not because you don't have the funds.
But because you've hit your carbon quota for the month.
Exactly. Or imagine your savings having an expiration date to force you to spend and stimulate the economy. Use it by December 31st or it disappears.
It turns money from a tool for freedom into a tool for social control.
It's the ultimate tool for a surveillance state. And that's why Griffin says this isn't just about protecting your wealth from inflation anymore.
It's about building a lifeboat.
That's his word for it. When the ship is sinking, you don't argue about how to patch the hull. You get in the lifeboats. And he claims that's what this Alpine Gold Exchange is, a lifeboat.
Okay, let's look at this lifeboat then. This brings us to segment 2, the solution. AGX, as they call it, proposes a Jeffersonian model of banking. So how is that actually different from the bank on my corner?
It really just boils down to one thing.
Yeah.
The reserve ratio.
Okay.
Your local bank is fractional reserve. AGX is a 100% reserve model.
Which means,
What?
in plain English,
It means if their ledger says you have 10 ounces of gold, there are physically 10 ounces of gold in a vault with your name on it.
it's not being loaned out.
It's not being leveraged.
Yeah.
It's not an asset on their balance sheet. It is simply your property being stored in their repository.
Sounds so simple, almost old-fashioned. Here's my stuff. Please keep it safe.
In the modern financial world, that is a revolutionary act.
And I want to clarify something here because this was confusing at first, looking at the documents. There seems to have been a big change around 2026 with the naming.
Yeah.
You see UPMA and Alpine Gold used almost interchangeably in older materials.
That's right. For years, people would say they had a UPMA account. But UPMA, the United Precious Metals Association, is actually a nonprofit cooperative.
Oh, no PID staff.
Right. It's not a business. It's more like a members association, an advocacy group.
So who is running the show? Who's minding the vault?
Alpine Gold Exchange,
Oh.
AGX. They're the service provider. The rebranding in 2026 was to make that crystal clear. Now you have an Alpine Gold account. AGX does the tech, the customer service, the operations.
So UPMA is still around, just has a different job now?
Exactly. UPMA is now the watchdog. Think of them as the industry auditor. They exist to make sure AGX is actually doing what it promises, holding 100% reserves. They provide accreditation and oversight.
And there's a third name in the legal briefs, Legal Tender Services, or LTS.
Yes. And this is the absolute legal key to the whole thing. They manage the escrow process
Why is that so important?
because it creates what's called a trust model. Remember, we said at a normal bank, you're a creditor.
Right, the guy at the back of the line.
With this LTS trust structure, you retain full legal title to your metal. It's held in what's called bailment.
Bailment, that's a new one for me.
It just means possession changes, but ownership does not.
Okay, like a valet.
Perfect analogy. You give the valet your keys. He possesses your car, but he doesn't own it. He can't sell your car to pay his debts. If the valet company goes bankrupt, the creditors can't touch your car.
So if AGX went under tomorrow,
The metal in the vault isn't their asset. It can't be seized by their creditors to pay their bills. It's still your property, just being stored in their facility.
that is a massive, massive difference.
To everything.
Okay, so we've got a secure vault, we've got legal title, 100% reserves, but we still have that age-old problem that's always plagued gold as money.
Fungibility.
Fungibility. I can't walk into a coffee shop and pay for a $4 latte with a $2,000 gold coin. The barista can't make change.
It's too clunky. That's the classic argument against it. And this is where the source material gets really interesting and moves into innovation. We have to talk about the Goldback.
I have to say, these things look amazing. I've seen the pictures. They're like these beautiful, ornate banknotes with these intricate designs.
Lady Liberty, the virtues.
Prudence, justice, yeah. But the claim is they aren't backed by gold. They are gold. How is that physically possible?
It's not paper. It's a type of polymer. And the technology is called vacuum deposition.
Okay.
They take pure 24 karat gold and they essentially bombard it atom by atom onto this polymer sheet. It creates a thin but continuous verifiable layer of actual gold sealed inside the note.
So that gold color isn't ink.
It is elemental gold. So
Right.
a 1 Goldback note doesn't represent a promise to pay gold.
Yeah.
It physically contains 1/1000th of a troy ounce of gold,
1/1000th of an ounce. So that's
Right.
what, $4 or $5?
depending on the spot price. Yeah. Suddenly you can buy a coffee. You can leave a tip. You can buy a gallon of gas.
It makes gold divisible for everyday use.
It solves the small transaction problem.
Huh.
And Griffin, in the interview, he admits he was super skeptical at first.
I would be too.
Yeah.
How do you know the gold is really in there? It looks like a fancy piece of plastic.
Right. You can't bite it like a pirate captain. And this is where they talk about the crucible test.
This part was great.
Yeah. So Mike Adams, the health ranger, who has his own independent science lab, apparently took a stack of Goldbacks and just threw them into a high temperature crucible.
He just torched them.
Torched them for science. The polymer coating just vaporized, burned away completely. But gold has a melting point of nearly 2000 degrees Fahrenheit. It doesn't burn.
So what was left?
At the bottom of the crucible were these perfect little beads of pure gold. He collected them, weighed them, and the weight matched the face value of the bills exactly.
You can't argue with physics. That's a pretty solid proof of funds.
It is. But there's a legal element to this too, right? They don't just call it money. They call it a specie legal tender instrument.
That sounds like some serious lawyer speak. What's the angle there?
It is. It's a very clever use of something called the Uniform Commercial Code, or UCC,
Okay.
because every Goldback has a convertibility clause printed on it, meaning you can exchange a large number of them for a U.S. minted gold coin. It's legally structured as a type of coupon or a commercial instrument.
And why does that specific legal distinction matter to me, the user?
In a word, taxes, capital gains tax.
Ah, the biggest headache for using gold.
The biggest. If you buy a gold coin for $1,000 and gold's value doubles, and then you use that coin to buy a $2,000 laptop.
The IRS says you just made a $1,000 profit and you owe them tax on it.
Right. Imagine having to calculate your cost basis for every single cup of coffee you buy. It makes it totally unusable as a day-to-day currency.
It's a nightmare.
But the legal argument here is that because the Goldback is structured this specific way, under the UCC, it's designed to circulate as money, not as a barter good. The goal is to avoid triggering a taxable event with every single transaction.
So you can create a little circular economy with them.
Localized is the word. The documents say thousands of merchants accept them, especially owner-operated businesses, the local hardware store, the farmer's market, that kind of thing.
But you're not paying for your Amazon order with a Goldback.
Not directly.
Yeah.
And that's the bridge we need to cross. Which brings us to segment 4, the actual strategy. Because to live on a gold standard today, you still have to interact with the fiat world.
You have to pay Netflix. You have to buy stuff online. You have to pay your property taxes, ironically enough.
And this is where the linked Visa debit card comes in. This is the piece that makes the whole system practical for an average person.
Okay, so how does this work? I'm guessing Visa's network doesn't run on gold?
No, definitely not. The card is the bridge. You go to the grocery store, you swipe the card for, say, $100.
Okay.
In that split second, a transaction happens in the background. AGX liquidates exactly $100 worth of gold from your vault account. They instantly convert it to fiat dollars and send those dollars to the merchant's bank.
So from my end, I'm spending gold, but from the merchant's end, they're just receiving dollars. They have no idea.
It's totally seamless to them. But, and this is a huge warning they repeat over and over in the source material, you have to follow what they call the 10% rule.
Yes, I saw this. The money, once it's on the card's balance, is no longer backed by gold.
Exactly. To make the card function, you have to have some cash sitting on it, ready to be spent. But that cash balance is just fiat. It's back in the baseball stadium parking lot. It's exposed to inflation. It's exposed to bank risk.
So the strategy isn't to just load up the card with thousands of dollars.
No. The strategy is just-in-time liquidity. You keep the vast majority of your wealth safe in the vault as gold.
Until the last possible second.
The last possible second. You set an automated threshold. Say, keep $500 on my card. If the balance drops below 200, automatically sell just enough gold to top it back up to 500.
So you're minimizing your exposure to the dollar. You only hold what you need for the next few days.
You're basically shortening the amount of time the hubcap thieves have to work on your car. You're only parking there for 5 minutes at a time.
That's smart. Now, speaking of the vault, there's another feature here that seems pretty advanced. Normally, gold is a lazy asset. It just sits there.
Right. It doesn't earn a dividend. In fact, you usually have to pay to store it. It has a negative yield.
But AGX offers a leasing program where you can actually earn interest in gold.
Yes, but this is where we have to be super clear, because this is where you can choose to reintroduce risk into the system.
How does it work?
You can opt in to lease a portion of your gold to industrial users. Think jewelers, high-tech manufacturers, anyone who needs physical gold for their business.
Okay.
They borrow your gold, they use it, and then they pay you back with interest. The returns are listed as between 2 and 3.5% per year.
So if I start with 100 ounces of gold, at the end of the year, I have 102 ounces.
102 ounces. Not the dollar equivalent. Your physical stack of metal actually gets bigger. But, and this is the critical part, for this to happen, your gold has to leave the vault.
So it's no longer part of the 100% reserve.
Correct. For that leased portion, you are temporarily opting out of that total protection. You're becoming a lender again. You're taking on counterparty risk.
So if the jeweler you lent it to goes bankrupt,
you're relying on contracts and insurance to get it back. It's not risk-free. But for many users, that positive yield is worth it. It covers any storage fees and actually compounds their wealth in real terms.
What's interesting is that it's a choice. In a normal bank, they lend your money whether you want them to or not. Here, you have to consciously opt in to that risk.
It's all about consent. It's voluntary. That's the philosophical difference.
There's one more tool I saw that was fascinating. The gold ELOC.
The gold equity line of credit.
Right. This seems like something you hear about people doing with their stock portfolio.
It's the exact same principle. It's the buy, borrow, die strategy, but applied to gold. So let's say you have $50,000 worth of gold in your account and you need 10 grand for a new roof.
Okay.
You could sell $10,000 of gold, but then you have to pay capital gains tax.
And you lose your exposure to gold. If the price goes up next year, you missed out.
Right. So instead, you borrow cash against your gold. You use the gold as collateral for a loan. The rates mentioned are quite low, around 2.4% APR.
And because it's a loan, it isn't taxable income.
That's the key. You get the cash you need without selling your core asset and without creating a taxable event. It lets you stay in sound money while still having access to fiat liquidity.
This really is a complete parallel system. Vaulting, spending, earning, borrowing. It's all there.
It is. But none of it works if the legal ground keeps shifting under your feet. And that brings us to our last big segment, the legal landscape.
Because you can have the best technology in the world, but if the government makes it illegal,
it's game over. And we're seeing this fascinating states versus the feds dynamic play out.
A kind of monetary Cold War.
Exactly. It's a reassertion of states' rights, and it really kicked off with the Utah Legal Tender Act back in 2011.
Utah was the first.
They were the pioneer. Their law officially recognized U.S. government-minted gold and silver coins as legal tender within the state.
And what did that mean for taxes in Utah?
It created a state tax credit for any capital gains recognized on those coins. So effectively, Utah removed the state income tax on gold and silver. They started treating it as money again, not just a taxable asset.
And now it's more than just Utah, right? The movement has spread.
Oh yeah. Over 40 states have now removed the sales tax from precious metals purchases, which is huge.
Because if you have to pay an 8 or 9% tax just to buy gold, you're starting in a hole.
You're starting with an instant 8% loss. Getting rid of that sales tax really levels the playing field between fiat currency and sound money.
But building the actual infrastructure, that's a different story.
Yeah.
The documents included a report from Tennessee that was, well, it was a bit of a reality check.
It was a feasibility study for a state-run Tennessee gold depository. The legislature basically asked, can we build our own Fort Knox? And the answer they came back was, probably not a good idea.
My favorite detail in that whole report was about the sewer pipes.
I know, it's hilarious, but it shows how serious this is. The insurance underwriters at Lloyd's of London have these insane requirements.
And one of them was
that the sewer pipes leading out of the proposed depository had to be too narrow for a person to crawl through.
They are literally planning for an Ocean's 11 style heist through the plumbing.
It sounds absurd, but it points to the immense cost of security. The armed guards, the seismic sensors, the vault walls. Tennessee realized the cost to build and run it would be astronomical.
But that wasn't even the biggest problem they found, was it? It was a Supreme Court decision.
Right, the Wayfair decision. South Dakota v. Wayfair. That's the case that said states can force online and out-of-state retailers to collect sales tax.
How does that impact a gold depository?
Well, at the time of the study, Tennessee still had a sales tax on gold. And they realized, why would anyone in another state buy gold, pay Tennessee sales tax on it, and then pay to store it in a Tennessee depository?
When they could just buy it and store it in Texas, which has no sales tax and its own state-run depository.
Exactly, the Texas Bullion Depository. So the Tennessee report basically concluded that unless they fix their tax laws first, building a depository would be a financial failure.
So even with some states hitting pause, the overall trend is clear. More and more states are making these moves. What's the end game for them?
The word they use is bulwark. They're building a defensive wall.
Against federal overreach.
Against federal monetary policy. If the dollar collapses, or if a CBDC is implemented in a way they see as tyrannical, states like Utah, Texas, Oklahoma, they want to have a legal framework and a physical stockpile of real money to keep their local economies functioning.
It's like a statewide insurance policy against the Fed.
That is the perfect way to describe it. They're acknowledging that the Federal Reserve note is a single point of failure for their entire state.
Okay, let's try and pull this all together. We have the problem. The Fed, inflation, the threat of CBDCs.
The hubcap thieves.
The hubcap thieves. We have the solution, the AGX 100% reserve vault model. We have the tech, Goldbacks for small transactions, the Visa card for big ones.
Yeah.
And we have the law states pushing back.
It's a complete ecosystem.
Yeah.
And what really stands out is that this isn't just theory anymore.
Right.
Griffin made a point of saying he shifted from educating to building.
Mm.
For decades, the sound money movement was about writing books and giving speeches, just complaining about the Fed.
And now it's about building an alternative.
Exactly. They aren't asking for permission anymore. They're just building a system that allows an individual to make the Fed irrelevant in their own life.
It brings up a final kind of provocative thought to end on. We've all been trained to think that keeping money in a bank is the safe, responsible thing to do.
And that buying gold is risky or speculative.
That's the conventional wisdom. But if you actually look at the parking lot...
And you see the hubcaps are missing from every car.
Right. If the safe option guarantees you a loss of purchasing power every single year, and the speculative option has held its value for 5,000 years...
The definition of risk has completely inverted. Staying 100% in fiat currency is the real gamble. You're betting on the prudence of politicians.
Which feels like a very long shot.
A very long shot.
And that leads to the final question I want to leave with you. It's something Griffin kept circling back to. He says politicians won't save us. The Fed isn't going to reform itself.
Because the system works exactly as it was designed to?
So the power has to lie with the individual, with the user. If a grassroots movement of people just starts using this, if they decide to hold 10% of their savings in it, then 20%, then start using it for transactions. Does that force a reset from the bottom up?
It creates a competition of currencies.
Can we simply choose a new standard of money without waiting for Congress to pass a law?
That's the ultimate power of a free market. If enough people vote with their wallets and choose sound money, the unsound money loses its power. It becomes a silent, peaceful revolution.
A revolution in your wallet. And that's the question for you to think about. Are you betting on the Fed's promises? Or are you betting on physics?
I think we know where the smart money's going.
We'll leave it there. Thanks for joining us for this deep dive into the world of sound money.
See you next time.
Unlock the future of fiduciary operations with Justice Fund, the digital platform that reshapes judgment claims and bills of exchange into efficient digital workflows. Experience advanced claim management with automated workflows, real-time updates, and secure exchange processing. Stay ahead with comprehensive compliance and reporting tools enhanced by military-grade multi-factor authentication and end-to-end encryption. Enjoy peace of mind with our platform's 99.9% uptime and record of zero security breaches. Justice Fund seamlessly integrates into your existing technology, slashing processing time by up to 70% and cutting operational costs by 65%. Benefit from customizable dashboards, advanced analytics, and dedicated support tailored for fiduciary professionals. Rest assured knowing that Justice Fund guarantees compliance with federal, state, and international regulations. Join the revolution in fiduciary management today with Justice Fund, your partner in efficiency and security. Are you a notary looking to significantly boost your income? Justice Fund Exchange is your pathway to earning up to $35,000 per month. By combining cutting-edge legal, financial, and technological tools, we transform traditional notary roles, process high-value financial documents like digital judgment fund claims and UCC-1 financing statements for substantial commissions. Our platform leverages blockchain technology and the Uniform Commercial Code for seamless transactions. We offer comprehensive training and tools to automate, verify, and market financial instruments. Unlock a new revenue stream beyond your regular notarial services with Justice Fund Exchange. Join us today and elevate your notary business to new heights. Step into the future of trust architecture with Chapter 4, the Trust Guardian's Shield. Bidzal Bay faced the ultimate certainty, mortality, but death was reimagined as a strategic liquidity event. The syntactical trust revolutionized bank-owned life insurance, integrating a fully autonomous management system. Tokenization transformed policy acquisition, creating an immutable audit trail secured by a quantum-resilient ledger. With AI-driven monitoring, health data triggered instant policy loans activated without human intervention. Liquidity reinvested in dynamic ventures from DRIPs to philanthropic EES strategies guided by AI insights. Upon death, a smart death trigger protocol autonomously distributed assets and satisfied tax obligations. In redefining mortality's role in financial planning, the trust perpetuated sovereign will across generations.